Hello and welcome. Today we're going to be talking about Caplin Point Laboratories on All About Your Company. Thanks for tuning in. I'm Harsh Saita. Let's look at what points we need to look out for where Caplin Point is concerned. One, it's done a consistent 15% kind of growth, and the real question is, can they continue to do that on the top line? So that's going to be my first question. And what's the growth outlook like for the next 3 years is what I'd want to know, because what analysts, and there are very few who are actually tracking this one, but what analysts seem to be projecting is that the growth could be somewhere in the lower double digit, at least for FY26, and thereafter we might see a pickup, but not 15%. And 15% is what they've managed for the last 3 years. The second piece is new products and US ANDA filings and how the approval pipeline for both of those is shaping up. They've been acquiring products in the US for US ANDA or US, and thereafter taking approval of US ANDA, and they believe that the US ANDA approvals are faster when products are actually acquired. So that's really the theory. You want to know what the approval pipeline looks like. The third piece is with regard to margins, whether they are sustainable at the current levels, 33 to 35%. They've guided that there could be a likelihood that it could touch 40 in the next 2 years. I'd want a clarification on whether they can actually do that. And second, what would lead them to do that? The fourth piece is what the company's US market strategy is, because US is a very different market from what they're currently operating in. They're currently operating more in LATAM markets, and therefore US is a different beast. What the strategy is over there is what I'd want to know. The fifth piece is the management has commented that it's a commoditized business. Whether such a commoditized business, what is Caplin Point's margin of safety moat in a business that is commoditized is what I want to know, and how are they deepening that moat? One of those moats is the kind of cash reserves that they have. Now they have around 1,334 crore rupees in cash. What are they going to do about that? And despite that 1,300 crore on the balance sheet, they're doing 25% ROC. So therefore, it's a very interesting company. You want to stay by and understand all of the metrics that will play out. But first off, with regard to the company itself and the business that they do, it's export oriented. Pretty much 100% of the top line comes only from exports or from markets abroad. Sometimes they're also relying on manufacturers in China to export, but regardless, the predominant market is Latin America and US. And US could be a growth market for Caplin Point in coming years. We'll know that better as we speak with management as well. Currently, they have 650 plus products and formulations. The pharma formulations exceed 5,000, and they operate in 36 therapeutic segments. Now, talking about the products that they do, or just some of them, they are into injectables, which is, of course, medicines taken via injection. Then there's ophthalmics, which is eye care. There is oncology, which is cancer-related. There is soft gels, ointments, powders, which is liquid, semi-liquid. All of those is what they operate in. And last off, there's tablets, capsules, liquid orals. So across the basket is what they operate. Nice diversified portfolio is what they have, is what I'm trying to say. In terms of segment, well, 75% is generics and 25% is branded generics. Now that has a better margin, of course, and branded generics is just increasing in terms of its share. It was just 5% in FY15 and it's currently at 25%. So in 10 years, they've been able to really ramp up with regard to branded generics. Let's talk about geographies they operate in, and Latin America is the largest one. 77% of their revenue comes from Latin America. Outside of that, 18% from US, as well as other markets in North America. And then you have Africa as well, which is an emerging market. It's the fastest growing for them, and that's currently just about at 5%. In terms of the channel of distribution, they rely heavily on their channels. They treat their channel as a possible moat as well. Channel and pricing is what they treat as moat. Now, in terms of currently, the wholesale channel is 45%, retail is 35%, and then institutional and tenders are around 20-odd%. So that is the broad-based understanding of what Caplin Point does in terms of business. And now in terms of what to expect going forward, before we do that, let's quickly look at the metrics. And we'll start off with the revenue. Look at the revenue growth, 15% odd. a fairly decent revenue clip and a fairly steady revenue clip. If you're seeing the way in which the revenue bars are increasing, there's no fluctuation there. And therefore, it looks like a very steady state increase, which is a positive. Let's talk about EBITDA in absolute terms. It's grown at 18% CAGR over the last 3 odd years. So from FY22, that number has gone to 651 crore in FY25. In terms of profitability as well, given the faster clip of EBITDA growth, you've seen profit also compound at 21% over the last 3 years. And therefore, it's a very, very healthy looking set of numbers when you're looking at the P&L account and you're seeing the way in which the business is scaling up. In terms of H1 FY26, it's clocked a top line of around 1,040 crore, which is 11% growth on a YOY basis, but EBITDA has grown at 16% YOY and profit has again grown at 21% YOY. So no concerns whatsoever when it comes to that. Just one piece within this P&L that you want to keep your eye out on is the effective tax rate. And while net profit has been growing, but your effective tax rate is in around 20%. I want to know why that is so as well. Are they opting for any tax benefits which could later expire is something I'd want to know better. Let's talk about operational efficiency, and margins is the best way to determine that in a pharma company. You look at the way in which margins have shaped up from 31 to 35 odd percent is what they fluctuate at, and they're fairly confident that they can maintain these margins as well. In fact, they're guiding for a PAT margin of 25%, but they've done a PAT margin of 28%. So they're in fact exceeding what the guidance seems to suggest. So again, positive with regard to operational efficiency that the business is building in as it scales. Let's talk about the balance sheet as well. Now, in terms of equity plus debt, it has around 3,160 crore of capitalized book value, which, of course, in terms of market cap, it's around 15,000 crore in terms of market cap. So you can derive the price to book at sub 5 times. You're looking at, even in terms of the borrowing, it's negligible. There were certain preferential shares which were issued, which have now expired. So broadly, the balance sheet is now completely clean. There's only that borrowing number of 5 crore. Let's talk about return ratios now. You look at the return ratios, very, very healthy. Oh, apologies. Let's look at cash flow first. Before we look at return ratios, let's look at cash flow from operations. You're looking at around a decent compounding even in terms of cash flow from operations. But what you're seeing is the EBITDA flow through is only 60 odd percent of, or rather the cash flow from operations is just about 60 to 70% of EBITDA. So the entire flow through is not happening. Some amount is getting blocked in working capital. That's what's playing out, and that's something you want to keep your eye out on as well. Whether that can get optimized, or will it remain as is, or could there be a downside risk to that? That's the other piece we want to understand. In terms of return ratios, let's pull it out. 26 to 28% is what the ROC numbers have been, which is very, very healthy, especially given the cash balance that the company holds. And we've spoken about the cash balance in the balance sheet at around 650 odd crore is what the cash balance currently sits at. That is pure cash. In fact, cash and cash equivalents, I did mention, completely was around 1,330 crore, which is large for a 15,000 crore market cap kind of company. Nearly 9% is what they hold in cash. Now, in terms of shareholding, promoters own 71%, no concerns there. FIs, DIs hold very negligible amounts, and the balance sits with the public. In terms of number of shareholders as well, it's crept up. So that's something you want to keep your eye out on. You want to be cautious. From 84,000 in FY22, that number currently stands at 94,000. So we've seen a creep up in terms of shareholders, which means that there are more shareholders participating in the story. In terms of valuations, let's look at that. In terms of your price to earnings, it currently trades at around 24 times FY26 price to earnings, given around a 12% kind of growth clip for FY26 and a 33% odd margin for FY26. In fact, for FY27, it trades at 21 times, which is, again, 14% growth for FY27 on the back of that growth and around a 35% margin. So they're expecting a margin inch up in FY27. This is the analyst community, of course. Just 2 analysts tracking this one. By the way, the 5-year average P is around 18.9 times, so it's trading at a slight bit premium, and therefore we are cautious on this. We've given this a neutral with regard to valuations. Analysts, only 2 covering it. 22% upside is what they see, so very healthy. But just the fact that there are only 2 analysts, again, we're being cautious here, and we've given this a neutral as well. Now, what we're going to do is we're going to speak with management. Mr. Vivek Partheeban Partheeban, who's the COO at Caplin Point, is going to join us in a few minutes from now. That's, of course, the snapshot, and we will show you the snapshot, but we'll take a small break, and we'll come back and speak with Vivek. Stay with us. Welcome back, and thanks for being with us. We have Mr. Vivek Partheeban, who is the COO at Caplin Point, joining us. Hi, Vivek. Good afternoon. First off, if we can also show the snapshot while Vivek is answering the first question. Now, Vivek, first let's talk about the key point here. How many new products in the pipeline? Give us a sense. And how many are going to be acquired for US ANDA purposes? Give us a pulse of that.
Okay, so we are currently sitting on around 40 plus approvals so far in Caplin Steriles, our US-focused arm, and we are in active discussions with third parties to acquire potentially another 10 to 11 products in the coming few months. In addition to this, we have an organic pipeline with our own R&D of more than 60 plus products that we are working on in various segments, which includes injectables, ophthalmics, oncology products, unit dose products, etc. So I would say overall, the pipeline for the next couple of years looks definitely quite robust.
And you spend around 5% odd in R&D every year. That's expensed out, I understand. Would you continue to do that? Would that go up? Would that go down? Vivek, how should one see it?
Yeah, so R&D is certainly a critical part of our overall growth strategies going forward, especially as a company. We are mid-sized right now, where only a business model differentiation alone might not be enough in certain areas. We need to have the right kind of product mix as well. So we continuously invest in the latest products and technologies, etc. So I would say the R&D as a pure number per se will continue to be in the same direction for at least another 2 years. And after that, we'll see where it goes, But I don't consider R&D something that is going to take a backseat or anything like that going forward.
That makes sense. Vivek, therefore, can you continue to grow at 15%? Because you've done that at a very steady state level. Can you continue to do that is what investors would really want to know. Give us a sense. And maybe you can't say it for FY26, but maybe over the next 2-3 years, would 15% be the aspirational run rate?
Yeah, let me take a step back to just because you hit upon the word consistency. That is something that our company has stood by for quite some time, and there's also a reason for that, right? So we may be into generics and branded generic products, but our business model is quite unique in the sense that we control the entire supply chain, whether it is manufacturing our own product or outsourcing products. 100% of all the products that we do in Latin America are only branded under Caplin Point. So the second thing is also that more than 70-80% of our business is currently in the private market. So it's certainly a very repeatable and predictable business. And it's also very measurable in terms of where we are and where we intend to be. So I would say that so far the growth rate has been quite steady. It has been, I would say, amongst peers, almost, I would say, at benchmark levels. Going forward, we are also working off of a larger base. So this year and next year, I would say 18 months hence is going to be something that we are looking at high single digits or low double digit level. But 27, 28 and beyond looks quite exciting for us. I don't want to give out any numbers at this point. But why it would be exciting also is because of the fact that many of the building blocks that we are putting in place right now, whether it's our entry into Mexico, Chile, and Brazil, which are the much larger markets of Latin America compared to where we are, whether it's our entry into the US with our own label, in addition to the B2B business that we are doing, in addition to the more complex molecules that we're getting into, whether it is getting into backward integration on API, our oncology business, all of these things are at a nascent stage right now. And what we do from here over the next 18 months should put us in a very interesting trajectory going forward, 28 and beyond.
Okay, so maybe just about double-digit growth all the way through FY27, FY28, it could pick up. and could be exciting. That's the indication. Give us a sense.
That's correct.
Is this going to be more of US focused, Africa focused? Where is the tilt going to be? Currently, or Latin America focused? Is the focus going to switch towards the US? Because I see that happening. You're acquiring 10 more products which could have a potential US ANDA approval in place in another year from now, is my understanding. Correct me if I'm wrong. So is US going to go up in terms of revenue share?
So two things here. I think US, as you mentioned correctly, it's definitely growing at a very good pace. We're at about 25-30% when it comes to overall growth year on year. So that should continue at least for another couple of years, because we are still at about 360-400 crores at this point. So off of a lower base, definitely that's something that is growing well. But when it comes to capacities as well, we're expanding significantly. We are right now at about 6 lines. In the next 12 to 18 months, we should be at close to 15 lines, which would make us almost, I would say, top 3, top 4 in terms of capacities coming out of India for the regulated markets and injectables and sterile products. When it comes to Latin America, I would say we are very, very focused towards getting into the larger markets now. Remember that 1,600 odd crores that we're doing in Latin America right now comes from the smaller geographies of Central America and certain parts of mainland South America. So the minute we enter into larger markets like Mexico, Chile, and Colombia, Brazil, etc., there is still quite a lot of white space. There's still quite a lot of headroom for us to grow into. Africa is something where we're doing purely branded business over there, but it's still 2 to 3% of our overall business as well right now. Are we expanding into Africa? Not really. Our market expansions and our focus is very much laser sharp towards North and South Americas at this point.
Understood. Vivek, I'll have to keep this quick. You've got 1334 crore of cash sitting in the balance sheet. You're looking at acquisitions of around 2,000 odd crore or in that range. What's the kind of product that you're looking to bring in as a part of that acquisition?
Yeah, so we are pretty agnostic towards what the inorganic route is going to be. But there are certain areas that we like very much. There are certain areas where the cash flow is always guaranteed. There are certain areas where we are comfortable doing safer. It could be something to do with distribution. It could be something to do with any piece in Latin America that can potentially fast track our entry into the larger markets. It could even be something in the domestic space where we understand that the cash flow and bottom line is fairly robust. That is something that is close to our hearts. That's something that fits in with our growth trajectory as well. So we're not shy towards writing a larger check. It just needs to blend in with our overall aspirations and our line of growth. Yeah.
Vivek, very quickly, effective tax rate is currently 20%. Is it going to be that? Is there some exemption you get?
No. So remember that almost 40% of our products, 35-40% of our products are manufactured in China and goes through our Hong Kong subsidiary, where we effectively don't pay any tax, because the products are manufactured in China and sold in Latin America and goes through our Hong Kong subsidiary, which is an offshore operation. So that might be one of the reasons.
Okay.
And all new
Vivek,
companies.
Apologies.
Okay.
Vivek, apologies,
No
but completely timed out on this edition of the show. Thank you so much for coming in and speaking with us. This has been a very good conversation. It's been an engaging one. Thank you for coming in and speaking with us. Viewers, out of time. Thank you so much for tuning in.